Hi, I'm Bill Baruch, president of Blue Line Capital, and I'm here with our analyst, Giannis Meindl. And this is the Triple Play podcast, where we bring you a macro backdrop with three stocks that we cover every week. We got a big one for you right now with Apple, Alphabet, and Amazon. So let's get to it. Giannis, hop into the macro.
Thanks, Bill. So let's start off with what the week sort of really got going last week, which was on Wednesday with the Fed meeting. They hiked 25 basis points, no surprise there. They did say that inflation eased but remains elevated. The committee also is looking at ongoing increases of the rate, so that was more the hawkish side. But then they balanced the more hawkish side of the statement with the fact that they're looking at the cumulative impact of tightening. And what really got it going and where stocks accelerated to the upside was when Jay Powell took the stage and he spoke about the fact that the disinflationary process has really gotten started. Bill, you're going to touch on his speech today at the Washington Economics Club. But that accelerated stocks to the upside. And then we also had the non-farm payrolls report coming in hot at 517,000 jobs added. Leisure and hospitality added more than 120,000 jobs, but wage pressures, even though there was a substantial add on the job side, were somewhat contained at 0.1% overall. Wage gains at 0.3 were also somewhat contained. So if we extrapolate that number out into the future and sort of anticipate that maybe the wage gains are going to stay similar, if we use last month's number and extrapolate that into September, we are facing a wage growth number on a year-over-year comparison sub 4%. So that's definitely painting an encouraging picture. The question will be whether labor availability is going to continue to tick up. We saw labor force participation tick up by 0.1%, or whether there are going to be more pressures in the system. And I think wages are definitely the most important factor here. We heard Jay Powell today reiterate that. But Bill, why don't you talk more about what Jay Powell said today and your perspective on things?
Yeah, thanks, Giannis. I've been in the softest landing camp for quite a while now. I got a little nervous at the end of the last year or start of this year, and as we started to see the services sector fall out, those PMIs didn't look good, and then the ISM services number early January didn't look good either. But one of our backdrops was that the consumer is still healthier, and they're paying and spending money, and they don't care about using credit. So for now, that's okay for the economy. And that was why we sort of expected the economy to sort of slug along here in the first quarter, looking for retail sales to bounce back. And it sounded like a broken record. But what we got last week in the data with the ISM non-manufacturing number, the services bouncing back pretty steadily, prices continuing to climb and expand at a very elevated rate. In the mid to high 60s. I mean, these are historical expansion levels, and this is month after month. So look at the ISM non-manufacturing telling us the economy is moving along pretty well. You have this blowout jobs report, and then you got JOLTS that over 11 million open jobs. Now, I know JOLTS could be a little off. I mean, people are coming up with reasons, but the number is what it is, and it's been elevated. It continues to be elevated because also we got jobless claims continue to go down, new lows since last April when the Fed began hiking rates. So I think the takeaway today, too, tying that into Fed Chair Powell at the Washington D.C. Economic Club was, listen, this is one number, and I've always looked at personally as needing three to be a trend. So this is only one number, but here's the thing. Essentially, Powell said it, and I agree with it, the cat's out of the box. This is it. I mean, we got this number, and if it continues to be like this, the market is offsides, and they're going to take rates higher. So where I come back to is if we see this, we're seeing the services sector climb back, and we see the job market continue to be robust. It is a indicator for inflation to continue to sort of move higher. And yes, there's these ebbs and flows, and we're ebbing down right now. But I think we're going to see these ebbs and flows in inflation. Should bounce back in this sort of environment. You got housing looking pretty good as well. The consumer is out there spending that money right now. So I think I'm really kind of in a spot right now that I think we're going to see rates rise back a little bit. In the near term. I mean, I'm watching the 30-year and the 10-year on the future side, and I think we're going to see those rates come back a bit. We'll have to see how the market digests Powell today, but at the end of the day, I think they're going to have to take rates more in line with Minneapolis Fed President Kashkari talking about 5.4%. We got other Fed speakers as the week develops too. So a lot to unpack here to start the week, and a lot more to come. Let's move on though, and let's jump right in. We got Alphabet coming up first. We decided to do all three of these big names. We own all three of these in portfolios, and obviously they all had earnings last week, so no better time to do a trio like this. Let's start off here. The next 12 months multiple on Alphabet is 22. It troughed at just a hair under 20, 19.9. Listen, it's still expensive by many measures, but I think for what you're getting and the diversification across business sectors, this is a fair multiple. I think for the stock. Now, one of the big things that stood out to me on the earnings release was YouTube revenues. They were down 8%. So I think that's something kind of just go in line with advertising in general. And we have note here that Forbes brought their advertising expectations down to 3.8% year over year compared to 8% in 2022. This is global advertising. So we know that advertising is going to be a headwind. Now, how much of that is already being discounted in names like Alphabet, as well, looking down to Meta. Obviously, you look at something like Snapchat, and that got crushed again. I mean, some of these companies, and one of our buzzwords this year is the haves and the have-nots. So, this kind of goes in line with, have these earnings expectations been written down? Have they for Alphabet? I think that's something to believe here. Now, is it just a screaming buy at this level? I wouldn't really be looking to chase it per se, but I think there's a lot to really unpack from what we've seen. And then one thing I also thought was really interesting last week is the antitrust move by the DOJ, and the market. It took it a stride. It was really expected, and we continue to see these headwinds to be digested by the stock price time and time again. So I think there's a lot here to unpack from an earnings report in general, but the stock has performed. I mean, with the broader market rebounding. Giannis, what do you have here as you get in a little more micro with this company?
Yeah, I mean, obviously, a lot of tech companies, as you've alluded to, with the advertising spending that's really coming off of this major peak here on the back of COVID, and a lot of companies are struggling, sort of renormalizing all their processes. I mean, we've seen that with layoffs, companies seeking more efficiencies. We also saw that with Meta. I mean, ultimately, Alphabet and the Google search engine remains the predominant play in the space. I mean, 84%. Alphabet owns 84% of the global search engine market. They own a little bit below 30% of the global digital advertising market. So they remain the predominant player, even with trends such as ChatGPT and the collaboration in between OpenAI and Microsoft. I think that not enough people give credit to what Alphabet has here. I mean, they have the DeepMind operation, which has been a leading innovator in the AI space. And then you also have to put things in perspective. I mean, of course, last quarter was maybe not ideal, but also we are looking at Google services and Google search revenues continuing to increase at a rate of 18% since 2017 on a compounded annual basis. And then we have this optionality in there with the Google Cloud being one of the predominant players in the space, the third largest behind AWS and Azure. And McKinsey did a study on why corporations really choose to have multiple different cloud providers, and one aspect is of course pricing. Companies don't want to be too dependent. Then all the different cloud providers do offer different functionalities for the needs of different businesses. So I think that there's we do know that the cloud has extremely high margins from AWS as a profit center for Amazon. We'll touch on that later. And we also know that from Azure at plus 70% gross margins on the cloud side there. So I think that there's still potential there. Maybe the Google search part of the operation is somewhat at saturation, and that will sort of grow along with what advertising spend does. But as you said, they're countering TikTok with their YouTube shorts. And so there are a lot of positive trends. Of course, it is valued at a 22 multiple. So lots of factors. I think that a lot of the AI trends to play a role, but they don't get enough credit there, I'd say.
Yeah, and you got Alphabet announced sort of their competition to OpenAI. They had this Bard that was announced earlier this week, so we'll see more about that. But I think tying two things you said together here, trends and compounded annual growth, And that's what Alphabet gives you. I mean, the compound annual growth across segments is even with YouTube. This is a great example. Down 8% revenue compared quarter four year over year. There's still compound annual growth rate of 29%. I mean, that's just how you're looking across all these segments. Let's move on to the chart here real quick on Alphabet. And one of the things I think is really interesting is you have this big fallout, and a lot of these stocks are rebounding right now. So you have a downtrend move, break out this above this downtrend line in Alphabet. I think that's a really nice move here. But we are facing this resistance from this consolidation period through middle of the year. So again, I said a moment ago, it's not the place to really be chasing Alphabet here, but there's definitely a lot. A lot to be looking forward to in a positive way, getting out of this downtrend. Maybe we kind of ping into this big area of resistance. Again, it's a 382 retracement as well as previous lows. And maybe we consolidate and back test that trend line. Listen, we own the stock. We've trimmed it ahead of earnings by about 10%. And I would be looking to get back into this as I look at the market environment. And if I want to add it, I would be looking at a back test in that trend line. Let's move back on here to Apple. Another one of these big names. And the reason I really talk about this next 12-month earnings, you'll see a bit about it when we talk about Amazon here next. But Apple's next 12 months, 24 multiple, not bad. I mean, it's elevated. What you're paying for here, you have to wonder, what are you paying for the higher multiple? I mean, a lot of names you're not really going to get much. But you look at an Alphabet, you look at an Apple, and you're going to get this diversification of revenue streams. And that is the thing that you're getting. That's why these are the behemoth tech stocks that they are. The diversification of revenue streams. So one of the things, the really takeaway here, buzzword and keyword here for Apple is the ecosystem. They really want to key off this ecosystem. Their services revenue is up 6% year over year. And then another one, industry trend in general that we Giannis and I here were talking about is the Apple wants the home pod. They want to be the entire part of your life. Everything that you're leaning on, left and right here, is going to be reliant on Apple, and that's where the services revenue is going to continue to drive this business. So that's something to really kind of look at here. Yes, the consumer may slow down a little bit, but for now we're getting some positive economic data that says the consumer is still alive and well. They're spending money, so I think that has been a tailwind for Apple. If you look back to Friday, when the non-farm payroll report was released, the day after these companies reported earnings on Thursday evening after the bell, Apple traded lower as much as 4%. It went positive after the non-farm payroll report. Reason being is you got these tailwinds from the services data, from the non-farm payroll data. If people are getting jobs, they're going to be spending money. That's something to really look at here with Apple. And the other thing I think is really great here is the Chinese consumer is doing pretty well too. They've doubled their deposits from 21 to 22. And the iPhone in general in emerging markets remains a status symbol. So you're going to see continued growth around the globe. So that's my rhetoric. That's my narrative on Apple. Giannis, why don't you hop in here on the data and the micro?
Yeah. So, I mean, last quarter was not ideal. I mean, there was a step down in revenue pretty much across segments except services, which continued to grow at a rate of 6% on a year-over-year comparison. I mean, this is predominantly still an iPhone story. iPhone revenues make up 56% of total revenues, but that is also down from close to 70%, 69 actually, in 2017. So they have diversified the revenue stream. There are more than 2 billion active devices in their ecosystem, and they have more than 900 million active subscriptions, including cloud, Apple Music, and such. So I think this is an extremely strong ecosystem, and that's what they will continue to leverage as they move into the home, as you alluded to, as they sort of push into more areas of your life, but they still have this cash flowing asset, which is the iPhone. So I think that there are a lot of positives to be had. I think if we look at current trends and what has gone on during the COVID period, there has been some concern in terms of the renewal rates of consumers and how fast they replace their existing phones. But ultimately, consumers continue to get new iPhones, continue to get new smartphones on a relatively frequent basis, 2.5 years-ish, and that is projected to go down. We saw some recovery on the net income margin compared to last quarter, although it is still about 200 basis points lower on a year-to-year comparison. Tim Cook did talk about continued supply chain problems, and he said that if they didn't have those, then revenues might not have disappointed the way they did. He also talked about an 800 basis points revenue impact from the foreign exchange side. So we talked about that offline, actually, right after the earnings call, that really was the thing that buoyed the market higher. And then as we think about going forward, and you talked about the emerging markets trends here, as more countries get into the higher echelon, sort of on the income per capita side, you look at countries like Indonesia with 270 million people. They're sort of bumping up against per capita income that's similar to China. Apple remains that status symbol. The iPhone remains that status symbol, and that's where future growth is going to be had. I mean, that's ultimately why the iOS market share is a lot higher in the US than it is abroad. So there's still market share to be had abroad. And while that happens, you also have the constant cash flows domestically. So I think this continues to be a stable play. It is a 24 multiple, but it is also tough to not participate in that story. I mean, there have been multiple stories where Tim Cook has traveled to Warren Buffett, and they have sort of redefined the way that Apple is returning cash to shareholders. If you think about that company and the fact they are generating close to $100 billion in net income each year, and then returning that money to shareholders, it does sound compelling, and that's ultimately why Berkshire Hathaway is one of the largest shareholders in the company as well.
Yeah, that's a great point. Let's take a look at the chart real quick. Again, for those of you watching this at home, there's a great chart book here. We've done a great job getting this stuff together for you. So dive into the chart book any chance you get and kind of run through the slides. There's a lot to unpack. We can't cover it all here in the podcast. We don't want to drag this thing out too long for you. We try to keep it right about 20 minutes or so. This Apple chart, I wanted to highlight back to the pandemic low of 2020. It's not a coincidence that the S&P went down to 3,500, hit that pandemic low. And ultimately, that's what Apple, now it wasn't the same time that it held, but that 50% has become a really big benchmark. And you look at what Apple's done here in recent weeks, it's ripped back. It broke out of a trend line. I highlighted a downtrend line that Alphabet did the same thing. So you got a lot of momentum here, but we're coming into the supply zone. So these aren't stocks you want to chase right now. And we own it in the portfolio. We did trim it 25% ahead of the earnings. After seeing some of this move, we did it maybe not in the last leg of the move, but we're just trying to manage portfolios, get a little cash here from time to time, and then so we can redeploy it. And that's the way we look at it with Apple. Just a little uncertainty, coming from the end of the quarter four, the negativity that took place in the quarter four. Remember, China wasn't totally open. It just started to open starting this year. So some of the questions about what Apple was going to put up as a number. And I think that's one of the reasons why the downside on Apple's the downside after Apple's earnings, wasn't much. It was more or less muted because there was some negativity around it. I think it gave a green light for those who are really eager to buy it. But still, I wouldn't chase it here as we move into the supply zone. Look for a back test into this trend line breakout. I think would be something as a good opportunity. Now, moving on here, Amazon, let's finish it up here of the trio. Now, as I noted, is the Apple next 12 months multiple is 24. Alphabet is 22. Next 12-month multiple here for Amazon is 86. 86. So one of the things that I thought was a really great exercise, and I've noted it a while back, I think in quarter four, is remove. First you got the next 12 multiple on the S&P 500, 17.5 or so, maybe 18 now. What you're looking at though is if you take Amazon out of the S&P and replace it with Apple, you're pulling down the multiple, the forward multiple, by 1.6. So you're getting this below 17, potentially even below 16 on a multiple basis, right, by simply removing Amazon from the S&P 500 and replacing with Apple. So does the S&P 500 multiple, is it an S&P 500 multiple problem, or is it an Amazon multiple problem? I think that's a really good thing to think about as we wonder where this market needs to be in order to be investable. Like people say, the multiple is too high to be investable. So I think one of the things that's driving this multiple for Amazon too, well, not what I think it is the consumer side of the business. It lost $2.8 billion last year. And, their spending in order to expand this business is dragging down the income. If you look conversely, something I think it was UPS did $13.8 billion in revenue, from Amazon shipping. and the logistics, this losing 2.8 billion, you're looking at UPS doing this business better. And I think that's one of the things to really take away. But it's really been the heart of Amazon's growth, and so they're not giving this up. But it's why this multiple is at the level that it is. And their net income margins were 10.4% in quarter four 2021. Net income margins now are 20 basis points in quarter four 2022. So you're seeing this become a big drag. There's obviously some questions moving forward, but I think we own the name. We like the AWS, and we like the potential that this has in a recovery from the lows last year. I wouldn't be chasing it at these levels, like I've said here with Apple and Amazon, though. But I think there's a really great story here. I think their consumer business will continue to improve, just arbitrarily. The question is, where does the consumer go from here, and does that drag on their business in the next 6 months?
Yeah, there's a real great way of laying out the Amazon story here. And of course, AWS continues to be this profit center for the company. I mean, North America retail makes up more than 60% of the company's revenues. The international retail business makes up more than 20%, and the rest is AWS. And while the revenue share is definitely more skewed to its retail business and the logistics involved on that end, you have AWS represent 180% of operating income. What does that mean? It means that international retail and also North America retail are actually losing money against what you might see with a UPS that's actually generating more than $13 billion in operating income. So this will be a question of how well can the company utilize their logistics network. I mean, you have seen the integration of Whole Foods, you see various initiatives on the technology side, and whether they can ultimately turn this business profitable. Again, Andy Jassy, the CEO, did talk about the fact that the one-day delivery that they're rolling out here in the North America space, that is definitely putting a drag on their net income and on operating margins. And as things normalize, they're hoping to also normalize the income associated with it. I think this is all about normalization, at least on the retail side. We saw before COVID happened that about 11% of total retail sales were associated with sales via e-commerce. Then it jumped to above 16% at the heights of COVID. And then right now we're sort of back to trend at more than 14%. So this is about renormalization, but we're ultimately ending up at a higher trend level than we were before. I think that some of the consumers will definitely be sticky as they've adopted the online the online areas of the economy, and sort of Amazon will continue to profit. The thing is, how can they ultimately monetize their extensive logistics network? I think one interesting graph that we have here in the chart pack is the fact that Amazon is really evolving into a logistics service provider. Almost 60% of total retail sales are third-party sales. So that means Amazon is doing the logistics, Amazon is providing the platform, but the product itself comes from a third-party seller. So they are sort of in the services provision business rather than them selling the products, them buying the products. They are less concerned with that as time goes on. And then just comparing package volume, Amazon is shipping more packages across the US than FedEx, and almost as many packages as UPS. So this will be about how to monetize those the gigantic number of sales that they generate, and can they turn that logistics center into also a profit center. Maybe not the same way that AWS is, because AWS does have extremely high operating and gross profit margins, but at least turn it profitable. And that is really the question here going forward with this company.
Great. Let's finish up with the chart here. I thought this was a really great chart to give you. This is a weekly going back to 2015, when Amazon actually became profitable, steadily profitable. They turned that corner in 2015. And listen, you had this big move post-COVID or through COVID, and we round-tripped it. We went all the way back down to the COVID lows. Ironically, I love seeing levels repeat themselves in aftermath of new things created, new highs being created. And what you got here is a 618 retracement that Amazon hit that last month or so, and it lines up perfectly with the COVID low. And then you have a lot of volume areas where the initial rise was through 2018 or so. It broke out. That was really where it broke out. So a lot of this lines up. You can see I highlighted that in the chart. So there's a tremendous amount of support there. Again, we're running into previous lows, similar to what we saw with Alphabet. There is no trend line breakout really with Amazon yet, but we're running into the supply. So again, these are very difficult to chase right now into this. We did trim Amazon ahead of earnings. We weren't sure what we were going to get. But I mean, overall, Amazon traded lower after earnings, and it's been hanging in there pretty well. I mean, it was, I think all three of them, Amazon, Alphabet, and Apple, all were disappointing earnings. But the market, in the way the broader market's trending here in recent weeks, they were able to kind of shake it off. So we'll have to see here how the market digests it in the next couple of weeks. But we'll be here, and thanks a lot for joining us. And if you have any questions, don't hesitate to email us, info@bluelinecapllc.com. And we would love to hear from you, any feedback at all. So thanks a lot. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.